Something strange is happening in Toronto right now, and if you own property in this city or you're thinking about buying, you need to pay very close attention to what I'm about to tell you. For the first time in years, homes are sitting on the market for weeks, sometimes months, without a single offer. Open houses that used to attract dozens of eager buyers are now seeing maybe 2 or 3 people walk through the door. Real estate agents who once bragged about selling homes in bidding wars within 48 hours are now quietly adjusting their expectations and having some very uncomfortable conversations with their clients. The Toronto housing market, one of the most resilient and overheated markets in all of North America, appears to be freezing right before our eyes, and buyers are suddenly nowhere to be found. If you want to understand exactly what's happening, why it's happening, and what this means for the future of real estate in Canada's largest city, make sure you hit that subscribe button right now, because I break down major market shifts like this every single week. And trust me, you don't want to miss what's coming next. Let's start with the numbers, because the data coming out of the Toronto Regional Real Estate Board is telling a story that very few people saw coming. In the most recent monthly report, home sales in the Greater Toronto Area dropped by over 16% compared to the same month last year. Now, a 16% drop might not sound catastrophic on its own, but here's what makes this truly alarming. This isn't just a one-month blip. We've now seen consecutive months of declining sales activity, and the trajectory is pointing sharply downward. The average selling price has also taken a hit, falling to around $1.06 million, which represents a year-over-year decline that has erased years of gains in some neighborhoods. But perhaps the most telling statistic of all is the surge in active listings. There are currently over 22,000 homes sitting on the market in the Greater Toronto Area, which is roughly double what we saw at the same time 2 years ago. That means supply is flooding in just as demand is drying up. And that combination is creating a perfect storm that is fundamentally reshaping the dynamics of this market. So what exactly happened? Where did all the buyers go? To understand this, we need to look at several factors that have converged at precisely the wrong time for sellers. The first and most obvious factor is interest rates. The Bank of Canada has maintained elevated interest rates in its fight against inflation. And while there have been some cuts, borrowing costs remain significantly higher than they were during the pandemic-fueled housing boom. Just 3 years ago, you could get a 5-year fixed mortgage at under 2%. Today, that same mortgage is hovering around 4.5% to 5%, and for variable rate holders, the situation is even more challenging. This might seem like a small difference on paper, but let me put this into perspective for you. On a $1 million home with a 20% down payment, the difference between a 2% mortgage and a 5% mortgage translates to roughly $1,500 more per month in mortgage payments. That's an extra $18,000 per year just in interest costs. For many potential buyers, especially first-time buyers who were already stretched thin, this additional cost has completely priced them out of the market. But interest rates alone don't explain the sudden disappearance of buyers. There's something deeper happening here, and it has to do with psychology and confidence. For decades, Canadian homebuyers operated under a fundamental assumption that real estate only goes up. This belief was so deeply ingrained that people would stretch their finances to the absolute limit to get into the market, convinced that whatever they paid today would look like a bargain in 5 years. That confidence has now been shattered. Buyers have watched prices decline in many Toronto neighborhoods over the past 2 years. They've seen friends and family members who bought at the peak now sitting on properties worth less than what they paid. They've read the headlines about rising delinquencies and mortgage renewals at much higher rates. And now, for the first time in a generation, many potential buyers are asking themselves a question that would have seemed absurd just a few years ago. What if prices keep falling? This shift in psychology is incredibly powerful, and once it takes hold, it can be very difficult to reverse. Buyers who believe prices will decline have every incentive to wait, and the more they wait, the more inventory builds up, which puts further downward pressure on prices, which reinforces the belief that waiting is the right strategy. It becomes a self-fulfilling prophecy. The situation is particularly acute in the condominium market, which has essentially become ground zero for Toronto's housing correction. Condo prices in the city have fallen by approximately 10 to 15% from their peak, depending on the neighborhood, and some areas have seen even steeper declines. The problem with condos is multifaceted. First, there's been a massive surge of new supply hitting the market, as buildings that were sold pre-construction during the boom years are now completing. Second, many investors who bought these units, expecting to rent them out and generate positive cash flow, are discovering that the math simply doesn't work at current interest rates. Monthly carrying costs, including mortgage, condo fees, property taxes, and insurance, are often exceeding rental income by several hundred or even $1,000 per month. These investors who once saw condos as can't-miss investments are now racing to sell before losses mount further. Third, the rental market itself has softened due to a combination of increased supply and federal government policies that have reduced the number of international students who were a significant source of rental demand. The result is a flood of condo listings with very few buyers interested in catching what many perceive to be a falling knife. The detached home market, while not as severely impacted as condos, is also showing clear signs of stress. Homes that would have received multiple offers above asking price just 2 years ago are now selling below asking after weeks or months on the market. Price reductions have become commonplace, and in some suburban areas like Brampton, Markham, and Vaughan, prices have declined by 15% or more from their pandemic peaks. These are communities where many buyers stretch themselves to afford homes at the top of the market, and some of those buyers are now facing significant financial pressure as their mortgages come up for renewal at higher rates. The irony is that while prices have fallen, homes are still not what anyone would call affordable. $1 million for a detached home in the suburbs is still far beyond what median household incomes can comfortably support. So even though prices are lower, they're not low enough to bring sideline buyers back into the market in meaningful numbers. Let's talk about what's happening on the ground, because the statistics only tell part of the story. Real estate agents across the Greater Toronto Area are reporting a dramatic shift in market dynamics. Open houses that used to require crowd control now feel quiet and subdued. Sellers who were once in the driver's seat, entertaining multiple offers and choosing the highest bidder, are now being forced to negotiate, offer incentives, and accept prices below their expectations. One agent I spoke with described the current market as a complete 180 from 2 years ago. Back then, buyers would show up with offers hundreds of thousands over asking, no conditions, willing to waive inspections, desperate to secure a property. Now, buyers have all the leverage. They're taking their time, requesting inspections, asking for price reductions, and walking away if their demands aren't met. For sellers, especially those who need to sell due to financial pressures or life circumstances, this is an incredibly challenging environment. Some are pulling their listings off the market, hoping for better conditions in the spring. Others are reluctantly accepting lower prices just to move on. The investor exodus is another critical piece of this puzzle. During the boom years, investors, both domestic and international, poured money into Toronto real estate, snapping up condos, pre-construction units, and rental properties. Many of these investors used aggressive leverage, counting on price appreciation and rental income to make the numbers work. Now, with prices falling and rental income insufficient to cover carrying costs, these investors are bleeding money every month. Some are choosing to sell, adding to the growing inventory. Others are trapped, unable to sell without crystallizing significant losses, but also unable to afford the negative cash flow indefinitely. This investor retreat has removed a significant source of demand from the market. During the boom, investors accounted for roughly 25 to 30% of purchases in some segments. Now that buying power has largely evaporated. There's also a demographic dimension to this story that deserves attention. For years, Toronto's housing market was supported by strong population growth, particularly from immigration. Canada has welcomed record numbers of immigrants and temporary residents, many of whom settled in the Greater Toronto Area. However, recent federal policy changes have signaled a shift toward reduced immigration targets and tighter controls on temporary residents, including international students and foreign workers. These changes, while perhaps necessary for other reasons, are removing a source of demand that the housing market had come to depend on. Fewer newcomers means fewer renters and fewer eventual home buyers. Some analysts believe this policy shift could have significant implications for housing demand over the next several years, particularly in markets like Toronto that have relied heavily on population growth to absorb new supply. Now let's address the elephant in the room. Is this a crash? That word gets thrown around a lot, and it's important to be precise about what we mean. A true crash implies a rapid, dramatic decline in prices, typically 30% or more, accompanied by widespread financial distress and forced selling. What we're seeing in Toronto right now is better described as a significant correction. Prices have fallen meaningfully from their peaks. Activity has slowed dramatically, and the market has clearly shifted from a seller's market to a buyer's market. However, we haven't yet seen the kind of panic selling or cascading foreclosures that characterize true housing crashes in places like the United States, in 2008 or more recently, in China. That said, the situation remains fragile. A large wave of mortgage renewals is coming over the next year or two, and many homeowners will be rolling from low pandemic-era rates to much higher current rates. If job losses increase or if economic conditions deteriorate, we could see more stress emerge in the market. The path forward depends significantly on interest rate policy, economic conditions, and government interventions. Speaking of government interventions, let's look at what policymakers are doing and what they might do in response to this slowdown. The Bank of Canada has begun cutting interest rates, and most forecasters expect further cuts over the coming year. Lower rates would certainly provide some relief to mortgage holders and could eventually help stabilize demand. However, rate cuts take time to filter through the economy, and the impact on housing markets is not immediate. On the fiscal side, both federal and provincial governments have introduced various measures aimed at housing affordability and supply, including incentives for construction, restrictions on foreign buyers, and programs for first-time buyers. Whether these measures will be sufficient to offset the current market weakness remains to be seen. Some housing advocates are calling for more aggressive interventions, while others argue that a price correction is exactly what the market needs to restore affordability. From an investment perspective, this market presents both risks and opportunities. For those considering buying a home to live in, the current environment offers more choices and more negotiating power than buyers have had in years. However, trying to time the bottom of a correction is notoriously difficult, and there's no guarantee that prices won't fall further before they stabilize. For investors, the calculus is more complicated. Cash flow negative properties are challenging to hold in the current environment, and the prospects for near-term price appreciation appear limited. However, investors with long-time horizons, low leverage, and the ability to weather short-term losses may find opportunities to acquire properties at attractive valuations. The key is to be realistic about expectations and to stress test any investment against scenarios where prices remain flat or decline further over the next several years. What about renters? Interestingly, the current market dynamics have created something of a mixed picture for renters. On one hand, increased supply in the rental market, particularly from investor-owned condos, has put some downward pressure on rents in certain areas. On the other hand, rents in Toronto remain extremely high by any reasonable standard, and the prospect of saving for a down payment while paying $2,500 or $3,000 per month in rent remains daunting for many. Some renters are choosing to stay on the sidelines, betting that falling prices might eventually make ownership more accessible. Others are looking at markets outside Toronto, either in smaller Ontario cities or in other provinces where housing costs are lower. Let me give you some context on how Toronto compares to other major markets, because we're not seeing this freeze in isolation. Housing markets across Canada have cooled significantly from their pandemic peaks. Vancouver, once the undisputed champion of Canadian housing unaffordability, has seen its own correction, with prices down notably from their highs. Calgary and Edmonton, buoyed by Alberta's oil-driven economy and interprovincial migration, have held up better than most, but are still seeing slower activity. Montreal, which saw dramatic price increases during the pandemic, has also experienced a pullback. What's unique about Toronto is the scale of the market and its importance to the Canadian economy. The Greater Toronto Area is home to nearly 7 million people and represents a substantial portion of Canada's economic output. What happens to Toronto's housing market has ripple effects that extend far beyond the city's borders. Looking ahead, what are the scenarios for how this plays out? In the optimistic scenario, interest rate cuts accelerate, confidence returns, buyers come off the sidelines, and the market finds a bottom in the next 12 to 18 months. Prices stabilize, perhaps 10 to 15% below their peaks, and gradually begin to recover as fundamentals improve. In a more pessimistic scenario, high interest rates persist, economic conditions deteriorate, unemployment rises, and the mortgage renewal wave triggers a significant increase in forced selling. In this scenario, prices could decline further, perhaps another 10 to 20% from current levels, and the recovery could take several years. The most likely outcome probably lies somewhere in between: a prolonged period of flat to modestly declining prices, with significant variation by property type and location, followed by a gradual recovery tied to the pace of interest rate normalization and population growth. Here's my take on all of this. What we're witnessing in Toronto is a long overdue reckoning with years of unsustainable price growth. For too long, Canadian housing policy encouraged speculation, discouraged supply, and treated rising home prices as an unalloyed good, rather than the mixed blessing they actually are. Rising prices are great for existing homeowners, but devastating for those trying to enter the market. The current correction, painful as it is for some, is actually creating a healthier and more sustainable foundation for the future. That doesn't mean the transition will be easy, or that there won't be casualties along the way. Some homeowners who bought at the peak will face financial hardship. Some investors will lose money. Some developers will face bankruptcy. But the alternative, continued exponential price growth that priced out an entire generation, was simply not sustainable. Markets eventually correct, and Toronto's market is correcting now. For those of you watching who are trying to navigate this environment, here's my advice. If you're a buyer, take your time. You have more leverage than you've had in years, so use it. Get a thorough inspection. Negotiate hard. Don't pay asking price unless the property is truly exceptional. And most importantly, buy because you want a home to live in, not because you're expecting rapid price appreciation. If you're a seller, be realistic about pricing. Overpricing your home in this market is a recipe for extended time on the market and eventual price reductions. Price competitively from the start and be prepared to negotiate. If you're an investor sitting on negative cash flow properties, take a hard look at your portfolio and make honest assessments about which properties are worth holding and which might be better to exit even at a loss. Continuing to bleed money every month on a property that may not appreciate for years is not a winning strategy. And if you're a renter trying to decide whether to buy, remember that renting is not throwing money away. In a declining or flat market, the flexibility of renting can actually be a significant advantage. The Toronto housing market is at a pivotal moment. The freeze we're seeing right now is real, and it's likely to persist for some time. Buyers have disappeared because the conditions that fueled the boom, low interest rates, fear of missing out, and confidence in endless price appreciation, have fundamentally changed. Until a new equilibrium is established, expect continued uncertainty and volatility. But also remember that housing markets are cyclical. What goes up eventually comes down, and what goes down eventually stabilizes and recovers. The key is to make decisions based on your own circumstances, your own timeline, and your own financial situation, not on hype, fear, or speculation. I hope this breakdown helped you understand what's really happening in the Toronto housing market and why buyers have suddenly vanished. This is a situation I'm going to continue monitoring closely because the developments over the next few months could have major implications for homeowners, buyers, renters, and investors across Canada. If you found this video valuable, please hit that like button because it really helps the channel grow and allows me to keep bringing you in-depth analysis like this. Drop a comment below with your thoughts. Are you a buyer waiting on the sidelines? A seller frustrated with the current market? An investor trying to figure out your next move? I want to hear from you because your perspectives help shape the content I create. And if you haven't already, subscribe to the channel and